Why McKinsey stopped GenAI projects in China. US-China tech tensions explained. In a significant shift, McKinsey & Company has instructed its China-based operations to stop all activities related to generative artificial intelligence, GenAI. This decision comes as the United States tightens its scrutiny on American businesses involved in sensitive technology sectors within China, marking a pivotal moment for one of the world's leading consulting firms. But here's where it gets controversial. The move not only restricts GenAI projects for multinational clients based in China but also highlights the broader implications of the escalating tech rivalry between the US and China. While McKinsey's local offices can continue working with older, established AI technologies, the firm is clearly navigating a complex landscape of geopolitical tensions and regulatory pressures. This strategic adjustment reflects the growing influence of US-China relations on the operations of Western companies, especially those engaged in cutting-edge fields like AI and quantum computing. For McKinsey, this means a reevaluation of its China strategy, with a renewed focus on serving private sector firms and multinational corporations, but without the use of GenAI. And this is the part most people miss. Despite the external restrictions, McKinsey continues to leverage AI internally. The firm's proprietary GenAI platform, Lily, introduced in 2023, remains a vital tool for automating tasks such as creating presentations and writing proposals. Over 75% of McKinsey's staff use Lily monthly, demonstrating the company's commitment to digital transformation even as external projects face political challenges. However, client-facing work that involves third-party tools like OpenAI's ChatGPT remains off-limits, particularly in scenarios where data security and cross-border compliance are at stake. This cautious approach underscores the delicate balance McKinsey must strike to operate effectively in a politically charged environment. The backdrop to this decision is a mounting concern in Washington about the potential misuse of U.S. technologies abroad. U.S. lawmakers have become increasingly vigilant, scrutinizing the role American companies might play in bolstering China's tech capabilities. McKinsey, which has faced criticism for its dealings with Chinese government-linked entities, is now taking proactive steps to avoid further scrutiny. Beijing, too, has tightened its grip on foreign business activities, imposing exit bans on certain U.S. citizens and enhancing surveillance. With over 1,000 employees spread across 6 cities in China, McKinsey is carefully navigating these new regulations to prevent being caught in the crossfire of the tech Cold War. To adapt to these changes, McKinsey is refocusing its efforts on non-GenAI services for the private sector and multinational corporations. A spokesperson emphasized the firm's commitment to enhancing client service policies to align with current legal and ethical standards. This shift is part of a larger trend in the consulting industry, where AI tools like Lily, BCG's Dexter, and Bain's Sage are automating tasks traditionally handled by junior analysts, leading to structural changes and layoffs. McKinsey's global headcount has already decreased from 45,000 to 40,000, reflecting the industry's evolving dynamics. What do you think about McKinsey's decision to halt GenAI projects in China? Is it a necessary precaution or an overreaction? Share your thoughts in the comments below. Navigating AI investment in a fragmented world, the future beyond China. Brace yourself. Global power plays are rewriting the rules of artificial intelligence investment, reshaping where money flows and who leads the next great leap forward. The tug-of-war between China's technological rise and escalating Western caution isn't just making headlines, it's forcing investors to rethink everything. Just take McKinsey's high-profile decision to limit its China operations from engaging in generative AI, a move that's not just symbolic, but part of a sweeping trend highlighting how fragile international tech ties have become. And this is the part most people miss. The old playbook of betting big on China is getting riskier by the day. To thrive, investors must look beyond China and seize new opportunities in Southeast Asia, India, and Brazil, regions now surging with AI innovation as global alliances and anxieties shift. China's AI industry has, for years, attracted waves of global capital. With government-backed infrastructure, a seemingly endless supply of new talent, and bold industrial initiatives, China seemed unstoppable. The 2025 release of DeepSeek R1, a large language model holding its own against international rivals, demonstrated the country's formidable technical progress. But here's where it gets controversial. At the very moment China is proving its prowess, its leadership is tightening the reins, steering AI with stricter oversight and a clear ideological agenda. This balancing act, pushing hard for cutting-edge advancements while simultaneously imposing heavier rules, creates a landscape that's as exciting as it is unpredictable for anyone with financial skin in the game. Isn't it a contradiction? Some say this helps stability, others claim it stifles innovation. Where do you stand? McKinsey's move is more than just one firm hedging its bets. It mirrors a deeper, widespread anxiety. Western companies are now reworking their China strategies, wary of intensifying regulation, new government restrictions, and the widening tech rift between the US and China. A notable example, American export bans on high-end AI chips have pushed upstart tech firms to rely on local supply networks, causing the once unified global AI ecosystem to fracture. While China has seen a jaw-dropping $127.3 billion in foreign capital flow in for the first half of 2025, and over half of this now transacts in yuan, a show of growing trust in China's currency, the backdrop is still marred by uncertainty and political risk. Anyone claiming the China gold rush is over might be exaggerating, but the era of easy bets is clearly gone. Shifting strategies, where smart money is headed now. No question about it, diversifying AI investments has become a strategic must. The real action? It's in markets once considered peripheral. ASEAN, India, and Brazil are fast emerging as the new seats of disruptive innovation, and each brings something special to the table. ASEAN, accelerating toward digital independence. Southeast Asia is quickly becoming ground zero for next-generation digital infrastructure, mainly as US and EU investors seek alternatives to China-centric supply chains. Just look at Singapore and Vietnam, which together drew $10 billion for AI-fueled data centers and semiconductor factories. What's noteworthy, and debatably ambitious, is ASEAN's regional approach to AI governance. By emphasizing shared rules over runaway dominance by any one player, they're betting on fairness and localized impact. Investing in vital upgrades like 5G and edge computing here? It isn't just a tech play, it positions investors inside a market growing at jaw-dropping speed. But is this coalition's policy approach practical, or overly idealistic? India, transforming future industries with AI. India's digital juggernaut is accelerating thanks to tech-savvy investments and a focus on AI that solves real-world problems, in sectors like farming and healthcare. More than $10 billion of AI funding has poured in since 2022, with American backers leading the charge. Initiatives such as the AI for Agriculture Innovation Program are transforming smallholder productivity, a real game-changer in rural economies. India's push for digital independence, from rolling out 5G to building smart cities, places it firmly at the front of the global AI race. Some say India is poised to leapfrog the West, others say challenges remain formidable. Agree or disagree? Brazil, AI with a conscience and a sustainable edge. Brazil is carving out a niche where artificial intelligence meets ethical oversight and environmental stewardship. The country has become a leader in AI ethics as part of UNESCO's global guidelines and is leveraging AI for everything from climate modeling to resource conservation. Green industrialization is not just policy speak, it's pulling in real investment, as seen in the new BYD electric vehicle factory in Bahia. What's perhaps most interesting is how Chinese investment and Brazilian priorities are blending, spurring debates on the ideal balance between foreign capital and local goals. Can this model truly address sustainability, or is it a new form of tech dependency in disguise? Navigating this new, fragmented AI world, key takeaways for investors. So, how can companies smartly reduce their China-specific risk in this volatile era? Here are the strategies winning attention. 1. Lead the charge into rising hotspots. Prioritize investments in Southeast Asia's digital setup, Indian tech for agriculture and healthcare, and Brazil's sustainable AI. These markets combine rapid growth with some measure of international insulation. 2. Build strong cross-border alliances. working in partnership with both global and local innovators helps manage regulatory uncertainty. For example, India's Technology Enterprises Channel in Hong Kong accelerates the growth of AI startups by merging local know-how with international capital. 3. Don't put all your currency eggs in one basket. With over half of China's capital inflows now in yuan, strengthening portfolio diversity to include RMB holdings in emerging economies can balance out risk. But don't get too comfortable. A host of risks, political, regulatory, and operational, mean you need adaptable strategies. The so-called AI Cold War is also giving rise to innovative outliers, think Snowflake and C3.ai, operating at the intersection of East and West, suggesting specialized opportunities for those agile enough to seize them. Where do we go from here? The next chapter of AI investment is about balance, pairing China's undeniable prowess with the resilience offered by up-and-coming centers of innovation. McKinsey's headline-grabbing pivot is merely one signal among many that global strategies are being urgently rewritten. For savvy investors, now is the time to establish a stake in ASEAN, India, and Brazil, regions already driving the next wave of AI breakthroughs. See these not merely as backup plans, but as potential pace-setters in tomorrow's tech race. But here's a question for you: is this new era a genuine democratization of AI investment? Or will old power players still find ways to dominate? Share your perspective and join the debate below. The window for early movers is closing fast.